Data center capacity across Europe's main markets is set to grow at 21% this year, adding 438 megawatts. But what is driving this rapid expansion, and is it contained to just the big cities of Frankfurt, London, Amsterdam, Paris, and Dublin? Joining me now is Matt Pullen, EVP and Managing Director for Europe at CyrusOne, to discuss how Europe's hosting monopoly is changing and how the business is building its footprint. Matt, thank you so much for joining me. It's been an eventful year, to say the least. I hope you've been doing well. What is happening in Europe and what makes Europe so special?
So your opening statement was interesting. Yeah, we're seeing a phenomenal rate of growth in Europe, predicted by the research houses. It's been long held that Europe should see growth significantly in excess of North America. A lot of the conservative research houses were suggesting a annual growth rate over the next 5 years of around 11 to 12% versus 6 to 7 in the US, with Asia being similar to Europe and LATAM probably slightly outpacing Europe and Asia, just simply because it's coming off a lower base. And what's driving it is the adoption of the cloud, not just consumers but enterprise. And we've been long predicting a significant uptick in the amount of enterprise spend on cloud services, and that's coming through, and that's what's driving the growth. And traditionally Europe has lagged behind the US in terms of outsourcing adoption. The cloud market is no different. So now that Europe is gathering pace, you're seeing it perform in a way that you saw in the US a few years ago.
That's interesting, but I think another interesting development in our continent, on this side of the Atlantic, is maybe the expansions outside of tier 1 cities. And even you recently just announced 21 megawatt expansion in Madrid. How is the market shifting from the FLAP-D, so the Frankfurt, London, Amsterdam, Paris, and Dublin, into now secondary markets like Madrid, Milan, Warsaw? Like there's loads of them. There's dozens of them now.
Yeah.
Yeah.
Well, it's really simple, and I sort of don't ascribe to the categorization tier 1, tier 2 at all, in that this is all about GDP. So what you're seeing is that as cloud companies open a region, what they're doing is they're starting to serve a country from within that country as opposed to outside of the country. And once they open a region, the growth in that region takes off. So cloud companies are chasing GDP, and as you see them opening regions, you see growth coming through. So those regions have been limited to to what you described as the tier 1, but the major markets, major GDP centres, most notably London and Frankfurt, but Paris saw the highest growth amongst the bigger markets last year. People talk about Amsterdam being part of FLAP-D, but actually when you look at the Dutch GDP, it's not one of the leading GDPs in Europe, and that's why you've seen more muted growth. And that's why you're then seeing people like us going and opening in markets where regions are being opened, but where there is strong GDP relative to the other centres in Europe. And Spain's GDP is particularly strong, and it's now a region, so it's natural that we would be there. Other people are making early bets on new regions, or where regions are expected to open, hence why you've seen particular focus on Milan, Warsaw, Zurich, Vienna, etc. It's a pretty straightforward equation here.
I do have quite a few follow-up questions on your expansion plans across Europe, but just to touch briefly on the investor sentiment across the continent, so not investors' sentiment related to CyrusOne, just the industry as a whole. We've seen a lot of activity. I mean, CyrusOne is also no stranger to investments, into acquisitions, and all the sort of changes and consolidations. What's your sense of the investor sentiment in Europe at the moment? Because we've seen a lot of transactions in the last even just month or 2 months, especially in the Nordics. And the profile of the investors seems to also be changing. So we're going from the guys that we used to be used to now completely different investors, institutional, wedge, funds of funds, pension funds. the whole thing seems to be changing, and where we are building data centers seems to also be changing. And it's all being kind of driven for this tsunami of money coming in. And there still seems to be more money than there is things to spend money on. So, I mean, tell me what you think of what's happening on an investment platform, investment level.
Yeah, so the big difference between the market we see today and the outlook versus the last couple of iterations of the data center market, being the telco boom and the enterprise phase, is that investors can see highly sustainable demand, and also income is being driven by some of the biggest, most creditworthy companies in the world. So there's a different dynamic that is attracting, therefore, a range of capital. And as you said, finally, institutional capital, infrastructure funds, as well as more traditional private equity. And I think what you're seeing, certainly because of the pandemic, is that there's a movement of capital into sectors that are viewed as more bulletproof in terms of future growth. Data centers clearly having demonstrated its resilience during the pandemic. So I think that's why you're seeing the range. I think you're seeing the wall of money because there are not that many industries that are viewed as bulletproof. So there's just a greater amount of money looking to come into data centers than previously. The opportunities also from people like our side of the fence is that wall of money offers low cost capital, and therefore as returns start to normalize in any maturing industry, ensuring that you've got access to lower cost capital is quite important to maintain returns. And you put all that together and you start to appreciate why you've seen the activity that's been seen. So, Green Mountain in Norway trading at a phenomenally high multiple. He's understanding from those basic dynamics. But the one thing that I'd add, which is we're seeing more and more, is that the capital is chasing platforms that are emerging with strong management teams, as opposed to necessarily going into startups. Because the fact is that unless you've got a strong management team with sufficient resources, you can't actually face off against the hyperscalers and ensure that you start to grow those hyperscalers within your portfolio, because the amount of resource that it takes to enter into commercial discussions, design discussions, and ultimately operate it's at a different level than it was going back 5 or 6 years to the beginning of the hyperscale boom. So a lot of the high multiples are being paid because they're not just acquiring the assets, but they're acquiring a management team that hopefully will drive regional growth and momentum.
Okay, that's interesting. So is it correct to kind of say that this is still very much a human capital business then? We're paying for the skills, we're investing in the skills to really grow the market. Is that kind of what you say?
I think it's a mixture. It's the fact that these are real assets offering very attractive returns, but in order to maintain the growth of any portfolio, you've got to have talented human capital that can really be sophisticated in its dealings with the world's biggest companies.
That's interesting. So how do you kind of see the skills / experience shortage? Because I mean, there's so much market out there, and there's also so much money. There isn't enough of us with experience in the industry, not even me, but people like yourself and other people with a lot of executive experience. How do you see this going then in the next, say, 10 years?
Well, I think it's just beholden on our industry to increase the size of the funnel of talent, and to look to other industries that have been impacted by the pandemic and whose recovery will be slow, but where the skill sets are easily transferable. Interestingly, I was talking to somebody this morning who's joining us into our IT function, coming out of aviation. We've had quite a few people come out of aviation. So not just IT, particularly facilities engineering, because of course those people are used to maintaining aircraft and it's fairly critical that aircraft keep flying. it's fairly critical that data centers keep running. But it's been great because, once an industry sector where there's a lot of connectivity between people in that sector starts to pivot towards another sector, you see that you're starting to recruit people across the functions from that sector. So we've got people from aviation in not just frontline roles, but also in support roles like finance, which is great.
That's very interesting. I mean, it's the first time that someone has made that point to me, so I find it very fascinating. The cash versus human capital, and the skills, and how we are bringing now expertise from other industries, because usually we talk about the management side of things, as in DCIMs and DMAS, and how utilities have been using it for quite a while, and now we're bringing all that into data centers and kind of modernizing it to modern digital infrastructure. So that's very interesting points you just made, actually. But going back to CyrusOne now, and really going now into your expansion plans, your portfolio in Europe is currently 200 megawatts. You've got new facilities coming up this year in London, Paris, and Frankfurt, and I believe you're also going to be opening another London and Frankfurt facility next year. And you've got 61 acres of land banking at the moment across the continent. I mean, what's the plan?
So, our strategy has been pretty clearly stated of late. We had our first investor day for a while back in June, particularly because of an appetite from the analysts and the market to really understand, what is your strategy? Where are you going? I think a few key highlights, and you've articulated the portfolio fantastically. Thanks. I don't need to remember all the metrics. But because of what we talked about at the beginning, in terms of Europe growth outpacing the US, there's a pretty big focus on capital allocation to Europe. And just to put that into perspective, on Xenium acquisition, which was 3 years ago, Europe contributed maybe 5%. By the end of this year, Europe will contribute 20% to the CyrusOne group. So the intent is to keep growing Europe on a higher growth curve than the US, mainly opportunity driven. So that's an important fact. You referenced the land bank that we've got, and interestingly, the focus on the land bank has been in London and in Frankfurt, where we've enjoyed really rapid growth, but so have others. So what's that dynamic that's driving it? Well, that's all about the fact that in the big GDP markets, the hyperscalers are probably growing at 10 megawatts per year at least in each availability zone, and that's significant growth. Whereas in the newer regions, the growth builds over time. So in the early days, it might be only a megawatt or 2 megawatts per availability zone. So it just means that the big GDP centers are rich in opportunities. So that drives a strategy for us, which says continue to focus expansion in those big GDP markets, London, Frankfurt, and for us, Paris, because we're now operational in Paris with one facility. But the next point is probably one of the most significant points for us, is that until we achieve scale in a market, you don't start seeing the operational cost benefits coming through, and those benefits can be quite significant. So it's obviously having very sustainable demand, but also opening up, to be honest, better returns by having scale and driving down operating cost. So that also indicates that, well, if we've opened in Madrid, for example, by buying land, that we're going to stay focused on that market, because the initial acquisition, 5 acres, which could produce about 18 megawatts of sellable capacity, we won't stop there, because we want to achieve scale in any market. And our approach to new markets will be along very similar lines, which is, be very, very, very clinical in terms of when we enter a market, based on, is it a region, is the GDP strong, and is there the opportunity to acquire from a location point of view the right land in the right places, i.e. the availability zones. And when we decide we're going to enter a market, it's then making sure that we've got a runway to growth to achieve the scale, to achieve the efficiency.
Picking up on the scale and the new markets, what new markets would you be looking at? If we went to your office and you had a map on the wall, where are the pins at?
Yeah, I think we were fairly clear in our investor day, and that what we're not about is effectively wanting lots of dots on the map. That's because then you grow in a particularly inefficient way, and you introduce growth risk into the portfolio, and you don't have efficiency as a result of what I've just mentioned. So we're not looking at multiple locations at the moment. We're tracking the new regions. We're tracking particularly how those regions are growing, because we're seeing how the new entrants get on. And as I said, we just then be clinical about markets we go at. But we've got a finite amount of resource, and as I said, what we're not going to do is go for a scattergun approach.
Okay. You did mention there might be maybe some acquisitions along the way. I guess all operators kind of keep that on the table at all times. Are you reading any sales deal books at the moment from any other company? Anything on the table?
The problem is, to be blunt, and we talked about this on Investor Day, we're challenged from an M&A point of view because of, let's say Green Mountain traded at 34 times. Initially, those sorts of acquisitions at those sorts of prices are not going to be accretive for our shareholders. So, over time, they may well become so, and really that would be the defining judgment in any M&A activity. Will it ultimately be accretive? And the time between now and when it might be is that time that we can accept. So the answer is we obviously look at things to be able to come to that conclusion, but it's selective, because what we don't want to be is in pursuits where we feel we're just not going to be competitive. The one exception, and we were clear in Investor Day around this, is Asia in particular, where we want to expand into Asia and grow. And for the very reasons I mentioned earlier, we don't see us doing that organically. We'd want to acquire a platform, a management team, along with some assets to give us an ability to secure momentum in a short period of time. So I guess the answer to the question is, we're not looking at a great deal in Europe, but very, very interested in M&A activity in Asia.
I think I know the answer to my next question. If I ask you who you're looking at in Asia, you won't be able to give me a name.
No, I won't. No, afraid not.
That sounds good. But look, my last question as well. So you, as you mentioned several times, you've had your earnings calls as well. You've released your Q2 results. There was an 11% growth in revenues compared to last year, second quarters of last year, about $285 million. What's next for the company on a global scale? And I know you've already mentioned Asia, but where does CyrusOne wants to go? What's the message now? Going into Q3, we are still very much living through COVID. There's still quite a lot of uncertainty around the world. What is the message for shareholders and investors in the market going into Q3 now?
I guess, as being part of the industry, I'd say on behalf of the industry to the wall of capital, be persistent. It's a great sector to invest in. We're on Investor Day, we talked about where returns, the type of returns that we're able to give to shareholders, and they're pretty attractive in consideration of other industries or asset classes. So keep investing. I think with Cyrus, what you'll see is an attempt to maintain our oversized share of demand. So I talked in Investor Day around the fact that in 2020, whilst in the major markets we only had about 8% of supply, we came close to 20%, securing 20% of headline signings from hyperscalers. And we want to maintain that momentum, because that will just slingshot our growth to really get us closer in terms of scale to the likes of Digital Realty and Equinix and NTT. So you're going to see a real doubling down of focus on growth in Europe, and you're going to see quite a determined position from Cyrus in terms of looking at Asia.
That sounds interesting. I mean, this is definitely an exciting time, and your shares speak for themselves. So it's all seems to be going well, as it is across the industry. But Matt Pullen, EVP and Managing Director for Europe at CyrusOne, thank you so much for coming on the show. And you at home, thank you so much for watching, and do check our website and give us a follow on social media for more breaking and timely news from across the digital infrastructure sector worldwide. And at Tech Capital, you lead, we report. Bye for now.